Welcome, ladies and gentlemen, to another information-packed episode of Dollars with Sense radio show and podcast. I'm your co-host, Terence Vanderwood, here with my fellow financial guru, Ela Lange.
Thank you, Terence, and hello, everyone. Thank you for tuning in. Comprehensive financial planning is our passion, and helping people grow and protect their wealth is our mission. And because we are planners, we like to look ahead. So today, we're going to shine a spotlight on the coming RRSP season starting January 2017. Yes, it's that time of year again, right after the Christmas holidays.
Yes, RRSP season begins January 1st of each year and lasts for 60 days. During this period, one is able to make contributions to their RRSP to retroactively reduce the previous year's income, thereby reducing their tax bill and hopefully producing a tax refund. But after all the Christmas presents are given and we all have hangovers from our New Year's parties, woohoo! Many Canadian wallets are empty. Are you scrambling to find the money to make your RRSP contributions?
Well, if you are, you're not alone. Many Canadians don't make regular monthly contributions to their RRSPs throughout the year and are left struggling in the first 60 days of the next year to come up with a large lump sum payment right after the holidays. So why not be proactive and plan ahead? Let's review some of the effective ways of contributing to your RRSP. But before we do that, we should remind our listeners that RRSP contributions make the most sense when you are in a high marginal tax rate. And I'm going to throw out a percent there, 31% and up.
But it is based on a case-by-case scenario, so it's very unique. Right, so if your income is low, you won't benefit nearly as much from a tax deduction. Generally, this is about $20,000 of income or lower. The point of using your RRSP effectively is the tax deferral. So if you're earning a lot of money, you are most certainly in a higher tax bracket. The registered retirement savings plans were introduced by the federal government way back in 1957. Hey, that's the year of one of my favorite cars, the 1957 Chevy Bel Air. Love that car. Anyways, it was established to encourage Canadians to extend their savings by specifically setting funds aside to provide income during their retirement years. An RRSP is a vehicle. What? An RRSP is a vehicle designed to address the savings or wealth accumulation phase of retirement plans.
RRSPs have special tax advantages, magical, that allow for the deferral of income tax, which has the potential to greatly accelerate the accumulation of savings. Contributions to RRSPs up to a specific annual limit may be deducted from the income, which reduces the amount of income tax payable. Savings within the RRSP grow tax sheltered, which we love, until the income is withdrawn from the plan in retirement.
And of course, we all know that in retirement, you generally drop a few tax brackets, so it's not as bad to withdraw from registered plans at that time of your life. Also, you may want to consider the fact that if you are currently earning under the amount that makes sense to make an RRSP contribution, roughly again $20,000 or less, remember that will allow you all the more room in the future to make more substantial contributions if and when you start earning a higher income. Any unused RRSP contribution room is carried forward from the end of the immediately preceding taxation year to infinity and beyond.
Your unused carry-forward RRSP contribution limits are available on your Notice of Assessments. That's where you'll also find any pension adjustments that have been made if you are participating in a registered pension plan or DPSP. The concept behind the pension adjustment is to create equity in the tax-assisted savings opportunities available to all Canadians. A pension adjustment ensures that all individuals with comparable income will have access to comparable tax assistance, regardless of the type of plan to which they belong.
Well, that sounds fair, right? Did you all know that there is no minimum age to which an RRSP may be established? That's right. The requirement to kickstart an RRSP is based on earned income, where the earned income has a specific definition. For example, the earned income has to be income from employment, royalties in respect to work or an invention. Artists, for example, the royalties that they collect would be considered earned income. Net rental income from any investment property, income from carrying on a business, receipt of taxable child and spouse support payments, just to name a few.
An income tax that is not considered earned income, directly affecting a taxpayer's contributions to an RSP, would be investment income, for example, capital gains or dividend income or interest income. Scholarships or bursaries, for example, received by a taxpayer. EI benefits, workers' comp, CPP retirement benefits, and OAS retirement benefits. Those are not considered earned income that are directly affecting a taxpayer's contributions to an RSP. So now that we've reviewed the basics, the question to ask yourself is, does it make sense to contribute? If the answer is yes, here's a few tips on how to do so effectively.
If your monthly cash flow allows, consider making monthly contributions over the course of the year. I'm going to refer to a slide we shared with you before to illustrate the 3 ways Canadians typically contribute to their RSPs. So say, for example, I'm making around $75,000 a year before taxes, so gross, and I decided I'd like to dump a $10,000 contribution for the year towards my RSP. Here are the 3 scenarios. The first has me putting $10,000 into my RRSP by the March 31st, 2017 deadline, and I'm going to do that every year for the next 20 years, making it so that I'm putting $200,000 of my money into the RSP, which will grow at 6% per year on average, which, by the way, folks, is a reasonable rate of return if you're invested with a diversified portfolio with a moderate profile risk, which you're going to get all these things from a great financial planner. We've just talked about all these elements in episode 36, which you can find on our YouTube channel. Just go to the YouTube search bar, type in Ela and Terence, and we will come up, and it's episode number 36, named Rates of Return and Your Risk. That will allow it to grow to $370,000, the first bar on our graph, which means I may receive $170,000 worth of growth.
Cool, you're almost doubling your money there. The second option, however, is a trickle strategy. You can trickle that same $10,000 in monthly contributions, so chopping up $10,000 over 12 months equals roughly $833. It grows with the same rate of return over 20 years to $385,000, $290. Now that's a difference of $15,614 than the first numbers Terence gave you. The immediate benefits of this strategy are investment returns are tax sheltered for longer and benefit from compound growth, so that's fun. Savings become a priority throughout the year since contributions are taken right off the pay. And guess what, folks? No need to panic.
Woohoo! No need to worry about it. Okay, so just to recap that scenario, we call this one the trickle effect. So I'm going to put in $833 a month, which equals $10,000 a year for 20 years, and that will grow with that reasonable rate of return of 6%, and that will equal $385,000, giving me $15,000 more than if I would dump it in by the deadline at the latest time possible.
Exactly. These numbers are all projections based on historic results of this type of activity. And to mention, a third option is investing the same $10,000 on January 1st. This is at the beginning of the taxation year. Now that grows to $395,776, a difference of $26,100, Terence.
So the third option to recap, is to dump the same amount at the beginning of the year with the same factors. I have made myself an extra $26,000 because I invested it at the beginning of the year as opposed to the end of the year. In retirement, that's probably half a year's income. Now, say you haven't contributed monthly and you find yourself 3 months away from the deadline without the lump sum you need to help you reduce your tax. You may consider an RRSP loan to, quote unquote, catch up with a large RRSP contribution room balance. Rates are very competitive, and although you'll pay interest in the amounts borrowed, the long-term benefits can far outweigh the interest costs. Plus, your contribution should trigger a tax refund that you can use to pay down the loan and keep interest to a minimum.
While all that is true, it's important we mention that borrowing to make an RRSP contribution isn't always the right financial choice. Remember, interest on an RRSP loan or line of credit is not tax deductible. Also, the investment return in the RRSP should be greater than or equal to the interest being charged on the borrowed money to justify the cost of borrowing. If an RRSP is fully invested, the investor is subject to investment volatility and market risk. We all know that. If the RRSP investments drop in value or fail to earn a return greater than the interest rate, one could end up paying more in interest than what is earned on investments for the year.
But with the guidance of great financial planning, these decisions are taken after carefully assessing your individual situations with a variety of factors in mind so that the solution makes sense to you, the client, and has long-term benefits. Lastly, folks, don't forget contributing to your spouse's RRSP can also be another great strategy. Tell us about that one, Ella.
That's right. Spousal registered retirement savings plans are one of the ways that Canadian couples, married, common law, or same-sex, can split income in retirement. Think of them as investment accounts for your spouse's retirement that allow you to contribute money tax-free each year. So your spouse will see a tax-free return on that money as well until it is withdrawn. They are often used to lighten the tax load for couples with big income disparity, as it avoids a higher income earner from having a large pile of retirement savings in his or her RRSP, while the lower income earner has a small pile.
It's far more advantageous to balance income where possible rather than have one spouse in a higher tax bracket and the other in a low tax bracket. When contributions are made to a spousal RRSP, the contribution does not affect the RRSP contribution room for the spouse who is the annuitant or the owner of the spousal plan. Contributions to a spousal RRSP affect the RRSP contribution room of the contributing spouse only.
Say that 5 times really
Can you say contribution 5 times really fast?
To understand the tax benefits that spousal RRSPs make possible, consider this example. You are a big earner. You make $100,000 a year, while your spouse makes $50,000 a year. If you both had RRSPs to which only the owner could contribute, you could put $18,000, which is 18%, into your RRSP. That's the maximum allowed for my salary each year, while your husband or wife could contribute $9,000 to his or her RRSP. Both amounts represent the maximum. So with a spousal RRSP, you can even things out a bit. You can contribute, say, $14,000 into yours and $4,000 into his or hers. You can still take the total, which is $18,000, deduct it on your income tax, and she will, of course, still contribute the $9,000 and take that deduction too.
Without spousal RRSPs, at retirement, you could have $1 million in savings while your spouse has $400,000. At a standard 4% withdrawal rate, you would be taking a $40,000 a year income and paying a lot of taxes, while your spouse is only taking $16,000 a year. Another note here is that when your income creeps higher, then you can get closer and closer to what's called the clawback area. And that's when the pensions that you receive, like Canada Pension Plan and OAS, the government holds back a little bit because you're making too much money. So with spousal RSPs, the goal is to equalize the retirement savings between spouses so that each one has a pot of $700,000 in this example and is withdrawing $28,000 a year each.
Okay, so here's a list of what to do before the start of the year. Ask yourself, 1, does it make sense to contribute to an RRSP? What will my total income be in 2016? 2, find your 2015 Notice of Assessment, or you can access your info online through the CRA website, that's the Canadian Revenue Agency's website, to see what your contribution room is to carry forward from previous years. What's your pension adjustment, if that's applicable, and how much makes sense to contribute? 3, does a contribution to my spouse's RRSP make sense? That's that whole discussion we just had. And 4, get ready for this question, do I need the help of a financial planner who can provide me with a written plan to help me determine the best way to grow my retirement funds and stay on track to obtaining a worry-free, happy, and healthy retirement? And you all know that you can reach out to us, right?
Yes, definitely. I would say of those action items, 1, 2, 3, and 4, number 2, checking up on your NOA and having those numbers either in a copy in front of you or written down in detail, and number 4 to be the 2 really most important action items for this week's show. To make sure that you've got somebody who can make sense of it all and give you the right advice and save you the taxes and perhaps even give you the refund.
And you know what, Terence, we could also suggest that would be your New Year's resolution. That this year coming, 2017, you are reaching out to a financial planner for assistance.
There you go. So we're going to take all 4 of those action items and put them into one and give you a New Year's resolution. Call your financial planner and get your refund from the government. So thanks, Ella. That's a really great idea. We hope you all have found this episode helpful. If you have any questions, please don't hesitate to reach out to us. We have a variety of ways that you can contact us, and we love to get your feedback and your questions and your comments. So you can do that via email at the 2financialgurus@gmail.com. That's the number 2financialgurus@gmail.com. You reach us by phone at 778-879-0820. You can also visit us on our Facebook page entitled Dollars with Cents, where you find all our episodes. If you like us and share us, then you can help spread the word. And fourthly, you can listen to us and all our 37 other episodes on Dollars with Cents on our YouTube channel. You just go to the YouTube search bar, type in Ela and Terence, and we will come up. Please subscribe so then that way you'll get notification when a new episode comes up. And by all means, please send us your comments.
Thanks, everybody, and thank you to our team over at 98.7 The Point, who help us bring this information over the radio waves to you week after week. And thank you to our listeners for your loyalty and your time and attention. Terence and I, your financial gurus, ask you not to keep us a secret. Pass on the good word and incredible knowledge to those in your circles that will benefit from these concepts and knowledge. On behalf of Terence and myself, have a great week, everyone. And may your dollars and cents be with you.